Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
Everyone.
You sent us a pretty interesting mix of articles this week.
Oh, yeah.
Wall Street Journal, Market Watch, Bloomberg, even some CNBC. Looks like you're trying to get a handle on
Wow.
what's happening in the global markets, which, to be honest, have been feeling a bit shaky lately.
Yeah, it's definitely a complex picture right now, and the fact that you're looking at sources from all over the world tells us just how interconnected things are. What happens in one corner of the globe can ripple out and affect everyone else.
Exactly. So today, let's do a deep dive into these articles. We'll try to unpack what's really going on
Okay.
and what you should be paying attention to in the coming weeks.
Sounds good.
So,
What's fascinating is that amid all the headlines about tech AI and even wildfires, the dollar's relentless rise keeps popping up. CNBC even calls it the dollar's longest winning streak in over a year.
okay, so let's start there. What's fueling this dollar dominance? Is it really as simple as the U.S. economy being stronger than everyone else's?
Well, it's not quite that simple, but the relative strength of the U.S. economy is definitely a factor. We're seeing rising bond yields here, which attract foreign investment. And there's a lot of anticipation around Friday's jobs report, which could signal continued economic growth. That makes the dollar attractive compared to, say, the struggling British pound, which Bloomberg notes hit a 14-month low.
Speaking of the pound, MarketWatch had this almost funny, almost terrifying anecdote about the UK's chief secretary to the Treasury not even being able to afford a Bloomberg subscription.
Oh, wow.
I mean, that's got to be a bad sign, right?
It certainly doesn't inspire confidence. Concerns about British finances have been mounting for a while now. They've seen a sell-off in gilts, which are UK government bonds, and that further weakens the pound. It's a bit of a domino effect.
Okay, so we've got a strong dollar, a weak pound, and then there's the elephant in the room, this Friday's U.S. jobs report.
Right.
MarketWatch is practically calling it a make-or-break moment for the markets.
Yeah.
Why is everyone so on edge about this particular data point?
It all comes down to the Fed and interest rates. Economists are predicting a slowdown in hiring, but still a decent number of jobs added in December. The Fed is watching this report very closely to see if their recent interest rate cuts are having the desired effect of cooling the economy without triggering a recession.
And if the report shows the economy is still running too hot,
Then we could see those bond vigilantes that MarketWatch mentioned really start flexing their muscles. Essentially, they're investors who sell off government bonds if they believe fiscal policy is unsustainable, which drives up yields. A strong jobs report might spook them because it could mean the Fed holds back on further rate cuts, potentially pushing the government deeper into debt.
so wait, back up for a second. What exactly are bond yields and why do they matter to, well, anyone who isn't a bond trader?
Good point. Bond yields are basically the return you get for lending money to the government. When yields go up, it means the government has to pay more to borrow money. And that can have ripple effects throughout the economy. It can affect mortgage rates, business loans, even things like car payments. So even if you don't directly invest in bonds, rising yields can hit your wallet in different ways.
Okay, that makes sense. So back to this global picture. Bloomberg isn't painting a very pretty picture for Chinese stocks. What's going on there?
Bloomberg says the MSCI China Index, which tracks a broad range of Chinese companies, is nearing a bear market. That means it's down 20% from its recent peak. They point to several factors: geopolitical risks, the potential for a trade war with the U.S. under the incoming Trump administration, and a weaker than expected Chinese economy. All of these things make investors nervous.
And it's not just China, right? Europe's facing its own set of challenges, as we see in some of the reports from CNBC and the Wall Street Journal.
Absolutely. Europe is grappling with political uncertainty and slower economic growth. The UK in particular is dealing with soaring bond yields, a weakening currency, and political instability. All of this contributes to a sense of anxiety in the global markets. It's like everyone's holding their breath, waiting to see what happens next.
It's like this interconnected web of uncertainty, right? One region's problems can quickly spill over into another. Speaking of interconnectedness, there were a few other stories that caught my eye, and I'd love to get your take on them. One from the Wall Street Journal really surprised me. BlackRock, a company that was a huge advocate for ESG investing, seems to be backing away from it. What's behind that shift?
It's an interesting development. BlackRock is pulling out of the Net Zero Asset Managers Initiative, a UN-sponsored climate group, citing legal inquiries and confusion around their ESG practices. They've also faced backlash from conservative states like Texas and Oklahoma who accuse them of boycotting fossil fuel companies.
So does this signal a broader retreat from ESG investing? I mean, BlackRock is a major player in that space.
It's hard to say for sure, but it definitely highlights the growing polarization around ESG. BlackRock still manages over $1 trillion in what they call sustainable investments. But that move suggests they're taking a more cautious approach, perhaps due to the political and legal pressures they're facing.
Okay, another intriguing story from the Wall Street Journal is about Wells Fargo hiring a top executive from JP Morgan to lead their credit card business. What's the strategy here? Is Wells Fargo trying to become the next big credit card giant?
That seems to be the goal. They've been launching more of their own credit cards and reevaluating their co-branded programs. Hiring someone like Ed Olabe, who led JP Morgan's branded credit card business, suggests they're serious about competing head-to-head with the major players in the credit card market.
Okay, and finally, there's this report from Bloomberg about India experiencing its highest bond outflows since 2020. What's driving that trend, and what does it tell us about the global investment landscape?
Global investors seem to be pulling back from emerging markets like India as the US dollar strengthens. The narrowing yield gap between Indian and US bonds is also making Indian bonds less attractive. And with the rupee trading at historic lows against the dollar, investors are understandably hesitant to put their money there.
So it all circles back to the dollar's strength, which seems to be the recurring theme here.
Yeah.
But here's a question. If the dollar is so strong, why is gold, which is typically seen as a safe haven asset, holding up so well? CNBC even commented on this, calling it a bit of a surprise.
That's where things get really interesting. You're right, a strong dollar usually puts downward pressure on gold prices, but this time it seems like investor anxieties are outweighing that currency effect. Gold is often seen as a hedge against economic uncertainty and a store of value that holds up during turmoil.
So even with a strong dollar, investors are still flocking to gold because they're worried about the future.
Exactly. The fact that gold is holding steady despite these headwinds tells us that there's a real undercurrent of fear in the markets. Investors are looking for safe havens, and gold for now is fitting that bill.
It seems like a classic flight to safety,
Yeah.
even with the dollar being so strong.
Exactly.
Okay, so we've covered a lot of ground here. The dollar's rise, the pound struggles, this looming jobs report, and those global market anxieties. But let's step back for a second. What does all this mean for you, the listener, who's trying to make sense of it all?
That's the million-dollar question, isn't it? We can't offer specific financial advice, of course, but what we can do is help you connect the dots and see how these seemingly distant events might impact your own financial decisions.
Exactly. So let's break down a few key takeaways.
Yeah.
First, the global economy is in a very uncertain phase right now. Rising interest rates, geopolitical risks, potential trade conflicts. It's a recipe for volatility. Second, while the dollar is strong, there are signs of stress in other currencies and markets like we've seen with the British pound and those bond outflows from India. And third, Friday's jobs report will be a crucial indicator of the Fed's next move on interest rates, which could have ripple effects across the globe.
Those are all excellent points. And it's worth remembering that we're just scratching the surface here. These are complex issues with a lot of moving parts. The key is to stay informed, keep learning, and be prepared to adapt as things unfold.
Absolutely. We always encourage you to dig deeper into these topics, explore the articles you sent, think about the connections between events, and consider how all of this might impact your own financial goals. Now, I don't want to end on a completely gloomy note. Bloomberg did have this report about Citi analysts predicting global stocks could rally 10% by the end of 2025. Is that just wishful thinking, or is there some substance to that optimism?
It's not entirely unfounded. Their prediction is based on a few things: strong corporate earnings growth, the expectation that equity gains will broaden beyond just the U.S. market, and a narrowing gap between big tech profits and the rest of the S&P 500.
So basically they're saying that while there are risks, there's also potential for growth, and it might be more spread out across different sectors than it has been in recent years.
Exactly, but a lot depends on those external factors we've been talking about, geopolitical tensions, trade policies, how well the global economy adapts to these higher interest rates.
Right, so even with this potential upside, it's not exactly smooth sailing ahead.
Yeah.
Okay, let's shift gears a bit and look at a few specific sectors that are making headlines. Bloomberg reports that oil prices are heading for their third weekly gain. What's driving that momentum? Is it just the usual supply and demand dynamics?
There's definitely a supply-demand element at play. We're seeing signs of market tightness with falling U.S. stockpiles, which pushes prices up. At the same time, there are still concerns about demand weakness in China, which is a huge oil importer.
So it's kind of a tug-of-war between these two forces.
Yeah, exactly. And how that plays out will determine the direction of oil prices going forward.
Okay, let's talk tech. We've already touched on the AI boom and those NVIDIA export restrictions, but MarketWatch has another interesting story about Taiwan Semiconductor manufacturing the world's biggest chip maker, posting record sales. What's the significance of that?
It's a pretty big deal because TSMC is a major supplier to companies like Apple and, yes, NVIDIA. Their strong performance suggests that demand for advanced semiconductors is still robust, even with all the talk of a global economic slowdown.
So even if there's a pullback in overall tech spending, some areas like AI and high-performance computing are still going strong.
That seems to be the case. And it really underscores just how essential TSMC is to the global tech supply chain. Without their manufacturing capabilities, a lot of leading tech companies would be in trouble.
Speaking of potential trouble, MarketWatch also has a live update about the Biden administration's plans to further restrict exports of AI chips to China.
Mm.
How do you see this playing out both in terms of the tech industry and the broader U.S.-China relationship?
This is a developing story, and it's a tricky situation for the Biden administration. They're concerned about China using AI for military purposes, so they're trying to limit their access to the most advanced technology. But at the same time, this could hurt U.S. companies like NVIDIA that rely heavily on the Chinese market for sales.
It's a tough balancing act, protecting national security while also maintaining U.S. economic competitiveness.
Absolutely. And it's a perfect example of how intertwined geopolitics and technology have become.
Okay, shifting back to the U.S.,
Yes.
CNBC has a pretty sobering report about Los Angeles facing the costliest wildfire damage in U.S. history. This is obviously a tragedy on a human level, but it also has broader economic implications, right?
Yes, the impact goes far beyond Los Angeles. The insured losses alone are estimated to be in the billions of dollars, which could put a huge strain on California's already fragile home insurance market.
And when insurance premiums go up, it affects affordability, potentially discouraging people from buying homes in high-risk areas.
Yeah.
It's a ripple effect that could have long-term consequences.
Exactly. It's a reminder that economic events are often intertwined with social and environmental factors. We can't always neatly separate them.
Before we move on to some of those smaller under-the-radar stories, I want to circle back to something you said earlier about understanding the forces shaping the global economy. We've touched on so many factors today: currencies, interest rates, geopolitics, technology. It's a lot to take in.
It is a lot, and it's easy to feel overwhelmed. But I think the goal isn't to become an expert on every single detail. It's more about recognizing the patterns, the connections, and developing a framework for thinking about how these things influence each other.
So it's like seeing the forest through the trees.
Exactly.
Yeah.
And once you start to see those patterns, it becomes less overwhelming and more like a fascinating puzzle to solve.
I like that analogy. Okay, let's take that puzzle-solving mindset into the final part of our deep dive today. We've looked at the big picture now. Let's zoom in on some of those smaller stories that might offer clues about what's to come.
Yeah, I'm ready for the smaller stories.
Perfect. First up, we have this report from Bloomberg about Colombian President Gustavo Petro's approval ratings taking a hit. What's going on down there? Is this just typical political ups and downs, or is there something more to it?
It seems like Colombians are growing increasingly disillusioned with Petro's handling of key issues like corruption and crime. His disapproval rating climbed to 56% in December, making him less popular than some other leaders in the region.
So even though he came in promising big changes, it sounds like those haven't materialized in a way that's resonating with the people.
Yeah, that's right. The poll highlights concerns about a struggling economy, a weakening peso, and rising inflation, all of which are contributing to public dissatisfaction.
Okay, next we have this tidbit from MarketWatch about bond vigilantes making a comeback. This seems to be a recurring theme this week.
It is, and it's a clear signal that investors are getting worried about government debt levels, especially with interest rates rising and inflation still lingering. Like the market is sending a message, a warning, really, that governments need to get their financial houses in order.
So it's not just about the U.S. then. This bond vigilante phenomenon is something to watch globally.
Absolutely. It suggests we could see more volatility in the bond market as investors demand higher yields to compensate for what they perceive as increased risk. This could have implications for governments around the world as they try to finance their spending.
Okay, and finally we have this story from MarketWatch that's almost too strange to believe. Apparently the British government is facing such a severe financial crisis that a key Treasury official can't even afford a Bloomberg subscription. I mean, is this real life?
I know it sounds like something out of a dark comedy, but it really highlights the dire straits the UK economy is in. It speaks volumes about the pressure on government finances and the tough choices they're having to make.
It also brings us back to that idea we talked about earlier, how interconnected everything is.
Yeah.
When a major economy like the UK struggles, it sends shockwaves throughout the global system.
Right, exactly. We're all in this together, whether we like it or not.
Well, on that note of global interconnectedness and shared responsibility, let's wrap up this deep dive. We've covered a lot of ground today: the dollar's strength, the wobbly pound, the upcoming jobs report, the global market anxieties, and even a few unexpected stories from Colombia to India. What are the key takeaways you hope our listener walks away with today?
I think the biggest takeaway is that we're in uncharted territory. The global economy is facing a confluence of challenges: rising interest rates, persistent inflation, geopolitical tensions, the rapid pace of technological change, and it's creating a very unpredictable environment.
And as we've seen, these challenges are all interconnected, and they can have ripple effects that are difficult to predict. So what's the best way for our listener to navigate this complex landscape?
Stay informed, be adaptable, and think critically. Don't just react to headlines. Dig deeper, try to understand the underlying forces at play, and don't be afraid to ask questions. And remember, this is just a starting point. We encourage you to explore these topics further, do your own research, and form your own conclusions.
That's great advice. And if you have any questions or insights, you know where to find us. We're always here to help you make sense of the ever-changing world of finance.
Exactly. The more we understand, the better equipped we'll be to navigate whatever challenges or opportunities lie ahead.
Well said. That's all the time we have for today. We hope you found this deep dive informative and engaging. We'll see you all tomorrow morning with new headlines from major financial magazines. Until then, stay curious and keep learning.